Ever look at your pay stub and wince? You work hard for your money, but before it even hits your bank account, a massive slice gets carved off and sent straight to the government. When Canadians try to protect what's left, they usually turn to the RRSP. However, common wisdom often mistakes the account for a specific bank product you buy, like a stock or a mutual fund. The Canada Revenue Agency defines the RRSP as a specific account type, a protective, tax-advantaged container designed to hold your various investments. This container builds long-term wealth while simultaneously and legally lowering your tax bill today. Keeping more of your paycheck requires understanding the mechanics of this container. We are going to map out exactly how money flows in, how it stays protected inside, and the strict rules for getting it back out. Phase 1 is getting your money in. The government limits your deposits using a metric called contribution room, which is calculated as 18% of your previous year's earned income. For 2026, the maximum you can add in a single year is $33,810. If you don't use your full limit, that room carries forward indefinitely, accumulating into a larger personal cap over time. The primary advantage of the input phase is the immediate impact on your taxes. Every dollar you deposit into this container is directly subtracted from your taxable income for that calendar year. This chart shows the math for someone earning $90,000. If they take $10,000 of that salary and deposit it into the container, the CRA ignores the original $90,000. Instead, they are taxed as if they only earned $80,000, triggering a substantial tax refund. By reducing your official income on paper, the input phase acts as a shield, redirecting money that was destined for the taxman back into your personal net worth. Once your money is deposited, Phase 2 begins. You put those dollars to work by filling the container with assets like exchange-traded funds, shares of individual stocks, bonds, or GICs. This graph compares two identical investments over 30 years. The jagged line at the bottom represents a normal account, where taxes siphon off a piece of the growth every single year. The top curve shows the same investment inside the RRSP, where dividends and capital gains compound without the friction of annual taxes. This environment is specifically optimized for U.S.-listed stocks and ETFs. Because of a tax treaty between Canada and the U.S., these assets are exempt from the standard 15% foreign withholding tax on dividends, a perk that other registered accounts don't receive. By completely eliminating this annual tax drag, the inside phase allows you investments to grow at their full mathematical potential. Eventually, you will want to access that wealth. That brings us to Phase 3, the output. The container has a valve at the bottom, and opening it comes with a condition. Every dollar withdrawn is taxed as regular income for that year. This is an advantage because of tax arbitrage. Look at the red slice. This represents an investor contributing during their high earning years to dodge a 40% tax rate. The blue slice is that same investor in retirement, withdrawing funds when they no longer have a salary and sit in a 20% bracket. Because the tax rate during withdrawal is lower than the rate during contribution, you pocket the difference as pure profit. If you open the valve too early, you break this math. Withdrawing from the container while you are still working means you will be taxed at your current high rate. You'll pay immediate withholding taxes, and you permanently lose that contribution room. There are only two legal exceptions with tax-free early access. The home buyer's plan lets you pull up to $60,000 for a first home, and the lifelong learning plan allows $20,000 for education. Both require you to repay the funds over a set timeline. Ultimately, the RRSP acts as a financial time machine, shifting the taxation of your income completely from your most expensive working years to your cheapest retirement years. Your strategy for this container must evolve with your career. In your 20s, the priority is securing any employer RRSP match. This is a guaranteed immediate return on your money that effectively doubles your contribution before it even starts growing. In your 30s and 40s, as your salary rises, RRSP deductions become more valuable. This is the time to ramp up contributions and consider a spousal RRSP, which allows you to split future retirement income and keep both partners in lower tax brackets. There is a mandatory endpoint to this timeline. By December 31st of the year you turn 71, the container must be converted into a registered retirement income fund, or RRIF, which enforces annual minimum withdrawals. Before making any deposit, verify your exact limit on the CRA My Account portal. The government penalizes over contributions with a 1% monthly tax on the excess, which can quickly erase your gains. Managing this container requires a lifelong strategic plan. When handled correctly, you effectively use tax savings to build a retirement fund supported by the government.